why don't we just jump into it? So what do you think the SEC aims to achieve with the 2026 examination priorities? And how do you think these goals are reflective of a broader regulatory theme under the current administration? Sean, maybe I'll kick it over to you to kick us off.
Sure. So, the SEC priorities tend to be fairly static, to be honest, year over year. I think that they are directionally important to see where the SEC will be focusing. However, they don't necessarily give you kind of real, true insight into what's going to happen during an examination. So I think a lot of it is kind of reading in between the lines. The SEC claims to be apolitical, but I think that there is a noticeable shift in priorities from the prior administration, which tended to be more prescriptive and focused on rulemaking. To be honest, I think that the SEC is going to kind of return to this kind of back to basics approach, if you will. So that's looking at fiduciary duty, examining the specificity and adequacy of disclosures, consumer retail protection or retail consumer protection. I think those are going to be the focus areas. I think there are certain tailwinds within the industry that dovetail into the SEC's focus as well. The democratization of alternatives is a big, topic that we're constantly hearing about. There's this massive generational wealth transfer. So I think that the SEC's priorities align with some of those industry trends as well.
Yes, Sean, I agree with that. And to echo a lot of what you were saying, one of the similar themes I noticed was the conflicts of interest in addition to those fiduciary duties. That is often a common theme, I think, that the SEC indicates in their exam priorities. But as part of the dovetailing with the recent trends, and especially the democratization, as Sean mentioned, in the exam priorities, the staff specifically referenced allocations of investment opportunities for those advisors who now advise multiple different types of products, including, for instance, some of those democratized products. And I do think, not that I think this is anything new in a sense, but it is a point of concern and something that people, they're paying attention to, and I think they are trying to get right and probably will. And the SEC has indicated they'll take a look and confirm too.
Yeah, I think I completely agree. Paul Atkins, famously quoted, examination should be a gotcha exercise. So I do think that there is a return back to a more collaborative business style approach to their monitoring activities. Just piggybacking off of that, what were your key takeaways from the 2026 examination priorities, and which elements do you believe will have the greatest impact on private funds advisors? And Sean, recognizing, like you correctly mentioned, some of that might be between the lines of what was actually released.
Yeah. So I think investor harm is priority number one. So I think it's returning to areas of historical focus, which are fee and expense allocation. So really digging into waterfalls. Valuation plays into this as well, especially when you're looking at many private markets oriented strategies. You have a shift in the manner in which fees are calculated pre-commitment versus post-commitment, right? So in the early stages, management fees are calculated on committed capital. Then once the assets are deployed and you're into the investment period, then it's based on invested capital. So shifting that cost basis, if there is an impairment or a write down, something like that, I think there's this convergence of finance and compliance that's occurring right now. And those two functions, which historically were more distinct and siloed, require a more integrated approach, right? Unless you're a dual-hatted CFO, CCO, you may not necessarily know how to calculate a complex waterfall and go through that process, but you need to make sure that you have the processes in place the checks and balances to make sure that your CFO or your controller or your fund administrator are running those calcs properly, and to our earlier point, matches up with the disclosure and representations that you're giving to LPs.
Yeah, and I agree with all of that. And actually, to echo one of Sean's points, I personally have noticed, I don't know if this is a broader trend, that the SEC staff and their exams are getting more pointed and direct, I'd say, with their questions even earlier on in the process, which is maybe a function of, this is all maturing and they're getting smarter and better at it. And they, when they might have started an exam with broader questions to try to learn a little bit more before getting to the pointed questions, they seem to be able to get those pointed questions a lot more quickly. And I think, clients, to the extent they're anticipating, because, we all kind of know what the potential pressure points or questions might be. And what people can do is anticipate that and just have their documentation ready, make sure they've followed their own processes when they did have one of those tricky questions of a conflict of interest, because the staff they're good, they're pointed, and they come and they ask specifically about those situations now. And to the extent people have that ready, it makes them look a lot better and they get off on a good foot.
Yeah, that's a really great point, Daniel. Just the sophistication of the examiners, right? And so less time for folks in the market to take those more obtuse questions to get organized. Like they're hitting with the hard questions or harder questions sooner. So there's not really that point in time where you can waste, right? You want to be able to put that best foot forward.
Yeah, and to that point, I think there are certain aggravating factors that play into the cadence of an exam. So, there has been this proliferation of continuation vehicles and GP-led secondaries, evergreen fund structures. I think a lot of those will cause the SEC to ratchet up the level of their questions rather than just, if it's, a traditional private equity fund, hey, vintage 1, 2, 3, 80% deployed, then you go on to capital raising for the next fund, and there's little overlapping investment periods, and it's more standardized, right? That's increasingly rare in today's environment. So we see a lot of private equity funds selling assets to themselves or amongst themselves, putting them in JV structures or co-investments, buying out LP interests. So I think, those complications should put managers on notice that the SEC is going to ask about them, right? Because if you don't have a straightforward business model, at the very least, the SEC is going to want to educate themselves on, what the mechanics are for this type of business decision, this new type of structure, this new type of transaction. And they should, you should expect, a more, consolidated effort to really get in under the hood to understand what's happening.
Yeah, I'd echo what Sean's saying, especially on the notion of the SEC using this as an opportunity to educate themselves. Back to what you were saying about this SEC under this administration being significantly more, call it pro-business, viewing, the registered advisors as their clients in a sense. I think that's very much true. And I very much believe that they will continue to use these exams as an opportunity to educate themselves about these newest products. The continuation funds and that, I think the SEC's clearly getting to a point where it might be a little bit less education and more scrutiny of how those deals are happening on the, these proliferation of these evergreen funds with these illiquid assets and somewhat liquidity terms that have, various gates. And, as we've all read in the news, sometimes investors don't, things that are fully disclosed to them up front, they still might not fully understand. And the SEC might still have some interest in that. I would expect people who are creating those novel products to, be ready to help the SEC understand them very well too.
Yeah, those are all great sort of observations of the current state of play, I'd say. Maybe just piggybacking off of some of those themes, in light of recent government shutdowns, how might disruptions in federal agency operations, impact SEC examination timelines, enforcement activities, or just overall preparedness for both regulators and registrants? Daniel, maybe I'll start with you.
Sure. So on exams, I think the SEC has already admitted that there would be a slower cadence because of that big gap of time. The more I spoke to one of the examiners, he said one of the bigger problems, it's not just, they're not allowed to do anything while they were on shutdown, which means when they came back, it took them time just to refresh their recollections of where everything was, and they have multiple things going on at a time, so that actually did have a material slowdown. The other item I've heard some of the SEC more senior staff mention is they had plans for more aggressive, call it more quickly deployed rulemaking that they've also admitted has had to slow down for the same reasons.
Yeah, I think there was definitely a backlog that developed in Q4 that we've seen roll into Q1. And it's not strictly just exams. Like, we've seen new launches, like new fundraising that's happening. I think, the first, call it 40 days of this, early 2026 has been the most active period I've seen in over a decade. And I think, to the staff's credit, they have ramped up exams where we've actually not seen a significant downtick in the occurrence of exams. I think the scope has been narrowed. I think, to Daniel's earlier point, education is always key to the SEC's process. And I think now that you're dealing with a much more well-informed regulator when they're going in, right? They're not asking questions tailored for a hedge fund to a private equity fund, right? It's like, hey, give me your trade blotter, right? Your trade blotter, if you run a venture capital fund, it's like, well, we invested in these 16 companies last year. Like, there's no trade blotter, right? So, I think the relevance of the inquiries is definitely up. One interesting stat that one of my clients, who is a former high-ranking SEC staffer, brought to my attention, though, was even despite the cuts, and this dates back decades, actually, there is a significantly higher number of enforcement cases brought under a Republican administration than a Democrat administration, which I thought, I don't have the numbers to back it up. However, this source was credible enough where I took it on its face. So I think some of that goes back to the fact that the SEC, their budget is controlled by Congress. If they can't show meaningful activity and fraud prevention or prosecution, then their budget is going to get cut further. I mean, I think we saw significant cuts, done by Elon and Doge, which, for what it's worth, was a huge windfall for IQEQ because we had lots of former people at the SEC take advantage of the early retirement option. So we got staff up. But, numbers are down anywhere from 10 to 20% across the agency, depending on which division you're in, which is necessarily going to have an impact. I mean, you can speak about AI and different tools, which, are at the SEC's disposal, excuse me. But, that there's certainly consideration there.
Yeah, you really bring up an interesting point that not only are we probably going to see potentially a whiplash effect, right, from the shutdown of the teams just playing catch up. Daniel, like you mentioned, just refreshing themselves on what they were working on pre-shutdown and then getting back to work. But potentially also, Sean, of like also justifying the budget, right? And keeping the activity going so that they can justify like operations continuing. So really great shouts. What do you think that this means for the registrants, you know, for folks that might be thinking ahead of potential examinations? Like how could this shutdown motion, whether it's a catch up or a future shutdown, how could that impact them?
I mean,
Daniel, I'll give that one to you.
yeah, the first thing I can think of is, I've got some clients who are going to be newly registered investment advisors. And I think we used to advise them that there was a chance they'd get cleared before the 45-day, I think it's a 45-day deadline the SEC gets. I might not be advising them that there's a high chance that it'll happen before the deadline. But otherwise, I don't know. I mean, like, look, you're less likely to get examined. I don't think that's something you can action on or anything, right. Like, I don't know if relying on a leaner SEC is any kind of path forward for anyone.
Yeah, I think, there were a few years ago where the SEC put a lot of capital into using the ADV as a risk evaluation, which would drive exam activity. I think we're likely to see that really start to bear fruit. In my mind, I think some of those complicating factors that I mentioned before, so evergreen structures, or if you're going to launch a registered investment company, or continuation vehicles, I think as the SEC sees that type of activity, it's going to certainly assets under management play into this as well, right? But when they see those type of business developments, I think you're likely to see an exam sooner than you would otherwise if you were more stagnant from a business perspective. Because when the SEC is trying to justify their budget, there is a bit of chasing headlines, if you will, right? It's much more poignant to go, chase a $10 billion fund who, is now has a retail access vehicle, and they're defrauding investors because they didn't fully disclose XYZ. That's going to appear in the Wall Street Journal. Whereas if, the staff goes after a $200 million wealth advisor who inadvertently miscalculated the fees on an IRA, and to the tune of $7 a month over the last 6 months, like that's not the type of action that is going to justify that fee, that is going to get their increased budget approved, that sort of thing.
Yeah, and to echo that, I've also heard that the SEC staff and enforcement are being pushed away from some of the broken windows type enforcement activities that have been happening in the past. I think specifically there was the off-channel communications had been a pretty easy kind of low-hanging fruit for a lot of local enforcement offices, and I think that in particular has been done away with. And I agree with Sean that to the extent you will see the enforcement, it'll be a lot less of those broad, small, call them, broken windows type activities being enforced broadly, and more poignant enforcement against the big individuals to the extent they have actually done something.
Yeah.
Really great segue. Just to broader themes, what should private markets firms be most concerned about or paying special attention to? If it's not like some of this more wide-reaching broken window enforcement, what trends do you expect to see, Daniel, other than maybe those big ticket items that are splashy in the news?
Yeah, so I think, back to what I was saying are those big themes, conflicts of interest and the trends of democratization, right? So I think the first is, to the extent a private, alternative asset manager is broadening their investor base somehow into the mass affluent, call it the retail, whatever channel it is, that I would think is, one of those, areas of particular concern, right? That's a place where you should pay particular attention to the new conflicts of interest, your existing disclosures, what new disclosures you might need. I think that's a big one. I think the continuation fund / GP-led secondary, the extent to which you read about these things just in the news now, like even like not even just the Financial Times anymore. Now I think it's down into the New York Times. That I think makes it clear that the SEC is going to be scrutinizing those types of transactions, right? So my overarching advice would be, to the extent you find yourself appearing before a broader investor base or engaging in any type of conflicted transaction that is really generating liquidity, those are the two big places you really need to be paying a lot of attention and making sure you're doing things right, which frankly most people are. It's the handful that don't, that generate those interesting news articles.
Yeah, I think that's right. And to build upon that, conflicts are inherent to the business. I mean, you're never going to eliminate all conflicts, and nor do you have to, right? That's not part of your fiduciary duty. You just need to disclose all material conflicts. I think one of the big hurdles amongst certainly closed-end funds is that the vast majority of sponsors view the PPM and the LPA as a one and done, right? You don't necessarily go back and revisit conflicts or amend the document and give updated versions out like a lot of hedge funds or open-ended fund managers do. So you're not necessarily thinking through new conflicts that arise that didn't exist or weren't contemplated 5 years ago when you went into fundraising mode. So I think it's important to have protocols in place where you revisit, hey, what are the conflicts that exist in our business today? Like, the market has changed, funds have changed, like all of these nuances that weren't necessarily prevalent back, before COVID are now everywhere. So I think the SEC is looking at how firms are addressing change management, so both regulatory change and business change, and how firms are investing in their compliance infrastructure. So there's obviously been this move towards outsourcing. I'm biased again, like it's a windfall for us, and I think it certainly makes sense to outsource certain tasks when you can't necessarily build the same expertise by bringing those in-house. But there are also new developments that are coming down the pipe that the SEC is also interested in, right? So the AML rule was pushed out to 2027. Right? Last year when that happened, it was like, oh, it's 2027. That's so far away. Like, I'm just gonna forget about this. It's not that far away now, right? And for fairly large fund complexes, it's going to take a lot of work to get done. So I've seen the SEC already inquire to say, hey, what are you doing on the AML front? Have you mapped out your risks? So that applies on a couple different levels. There's the typical AML KYC during the investor onboarding. There's the refresh. There is the reverse AML KYC also, right? That's coming up now, where you have to make sure that your disclosures match what you're actually doing. There's also macroeconomic and political currents that AML is this constantly evolving dynamic now, right? So like, whether it's Venezuela or it's Ukraine, and there's this oligarch that's fine today, but blacklisted tomorrow. I think the SEC is looking at, hey, what are you doing to address all of these kind of these issues that present a moving target? So, that's a big one. I do think with with evergreen funds and some of these illiquid strategies that are being put into a semi-liquid wrapper, liquidity risk management programs, right? That was, a 40 Act concern a few years ago. Well, now fund sponsors are going into the registered fund space, right? And they don't necessarily have the expertise in-house or experience, right? A lot of these are traditional private equity guys, right? And all of a sudden they're like, what do you mean I need to put together a liquidity risk management program and I have to do this, and oh, don't worry, our anchor has preferential liquidity terms. Like, that's not a problem, is it? Yeah, it actually is, especially when you're dealing with retail investors. So that investor that comes in with 50K, it doesn't make a difference. Like, if your anchor has 50 million with you, you still need to treat them on kind of an equal playing field.
Really great insights. And I think, Daniel, I'd love to ask, like, from your perspective, what systems have you seen some of your clients put in place to address like all of those, like, I'd say trap areas that Sean highlighted?
Yeah, so where I tend to come in is the upfront disclosure about these conflicts as they're coming in, right? And so what I can do is I help my clients anticipate to disclose as much as possible so you can get informed consent. As Sean mentioned, these closed-end funds, you really only get that one bite at your investors because they don't, they make that commitment, they're locked in for the next 10 years. So the goal is to disclose up front what those conflicts are and how you would solve them, develop the compliance policies, investment allocation policies, disclose the liquidity risk. I will say it was fun for me to hear Sean talking about how in the registered space, people actually have to manage their liquidity. In the private fund space, we get to disclose that there is no such liquidity and it might not ever appear. I will say, I am curious to know how that type of disclosure and the reality flies as these products become more and more prevalent. As I'm sure all of us remember when BREIT complied with its disclosures and just did what it was designed to do, which was prevent unnecessary sales of assets to meet a flood of redemption requests. And it did what it was designed to do, and it weathered that and went through it. But the press was different from that. And so I am curious to see how this plays out as these products become more broadly available. And like I said, all you can do is try to disclose it up front, get the permission to solve those conflicts you couldn't disclose in a manner that doesn't require to go to your LPs. But sometimes, the right answer is you gotta, you're dealing with too big of a conflict that wasn't disclosed in the right way at the time. And the right answer is to go and get the consent again. And that's fine. And advisors need to be prepared for that.
It's a fine line between running a fund with liquidity rights and a Ponzi scheme, right? So I think this disclosure is really everything at the end of the day, and making sure that you're to your earlier point, like, you really need to think about these things on the front end, right? Because sometimes post-launch, it's already too late to deal with some of these items. And I think when we're having conversations with sponsors that are saying, yeah, the natural progression is we're going to do an evergreen structure. Oh, how are you going to deal with liquidity? We'll keep 10% in cash equivalents or something like that. Oh yeah, and then we have this credit facility available. So leverage comes into play as like this end-all be-all solution, which in reality causes so many other complications as well, right? You can goose performance by playing with leverage. And to be honest, some of your institutional LPs may want you to juice up your returns using leverage because it makes them look good, so they can go back to their board and say, I allocated to this fund who's returning, you know, 22% year over year to us. So I think a lot of these things, you know, come into play. So there are so many different factors. The other thing I'll add to this is, because it's relevant to the retail conversation, the new privacy regs, right? Reg SP, and how you're complying with those new regulations that require things like vendor due diligence and mapping out your environment. So, you know, most middle market funds don't necessarily have that expertise internally. So where are you looking to get those solutions? Historically, like things like vendor due diligence were incredibly manual, and, you know, funds that tried to solve for that internally, hey, you know, I'm going to send, you know, Mr. Bulge Bracket Bank a 12-page vendor due diligence questionnaire, and I'm never going to get a response. And even if I do, I'm not going to understand half of the terms anyway. And even if I did, I still have no leverage to actually go back and say, hey, we want you to do phishing, you know, phishing testing on a more frequent basis, right? So, I mean, these are more hurdles that are coming into play, which, you know, this has been on the SEC's agenda for a while, but I think it's one of the few regulations that, you know, obviously survived the initial look at some of the new rules that were passed. And, you know, going forward, it's certainly not GDPR like Europe, but, you know, there's this trend towards protection of private data and private information.
Yeah, I think all of that is spot on, and definitely a trend that folks should be thinking of. Maybe just as a point to wrap us up, right? When firms are thinking ahead for the rest of this year, what steps do you think that they could take to ensure that they're positioned for success right now? I know you mentioned, hey, this is an issue that probably we need to discuss pre-closing versus post-closing. So any other items like that, you know, that you think folks should be aligning themselves on internally as they're looking to the year ahead, as it relates to what we're seeing signaled from the SEC thus far?
Daniel, you want to go first?
Yeah, well, so one thing I always like to advise my clients that they do is at least once a year, they sit down and they go through their LPAs and their side letters. And I don't mean them literally all of them. We like to focus on what we call like affirmative GP obligations. You know, those things that it says you will do, not at request, and just go through and, you know, confirm you did, right? I'm not saying you have to necessarily admit when you didn't, but that's a good process to go through. That's number one. And then two, I would also advise them any conflicts of interest whatsoever, minor, whatever they were that you experienced over the last year, just sit down and see how did they fit into your existing disclosure and the way you mitigated them and handled them. Was it all, did it fit within those four corners, or is there anything you would suggest modifying slightly the next time you're going around and providing this disclosure to your LPs, right? So once a year, I think it's a good idea to make sure how things were going are in compliance with what we've always said, and it advises you and gives you a sense of what you might want to do better in the next year.
Yeah, I think it's important to each firm that they go through the exercise of looking at what the SEC is focusing on and preparing yourself proactively for an exam. I'm not saying everybody needs to do a mock exam with interviews and formal request lists, but the information is readily available, right? I mean, if you can go on ChatGPT and literally say, what are the SEC's priorities? You know, give me a summary of the last 12 months of enforcement cases. It's not hard to find this stuff. You can also just, you know, Google or join CCO groups where you get sample request letters. So you see exactly what this looks like. Talk to people. I mean, it's fairly well known that the exam process goes, you get a call from the SEC. They say, a request letter is going to be in your inbox by the end of day. You're going to have 2 weeks to respond. Make sure your books and records are properly cataloged. Make sure you know where the information is. Make sure you know, hey, if an exam is going to happen, who am I going to loop in to talk about fee and expense calculations? Who talks about deal allocation? Hey, there's these these co-investments over here. Who's responsible for, sourcing co-investors and deciding who gets a look and over, the LPs that don't? So all of these areas, right? Like just button it up. Valuation. Make sure your documentation is airtight. Like anything that can be a catalyst for investor loss is going to be a focal area for the SEC. And if there's investor loss, that likely means that something's going to go, you're either going to have to cut a check back to investors. And then, that obviously doesn't look good for you when you have to say, hey, I'm reimbursing you for whatever. Or there's a likelihood that it goes to enforcement if the staff feels that it's a systematic problem. And it's probably part of a larger failure of internal controls.